Hey, welcome to Everything Money. We're glad you joined us again. Today, you will learn about Apple. We will update you on the financials, go through a fundamental analysis to show the difference between the financials of a company and a stock ticker. We will move toward getting a prediction of what you should be paying for Apple moving forward in the next 10 years using our software and stock analyzer tool. If you're looking to trade Apple at a quicker pace, you can join Mo in the Bid and Ask Nation. He will show you the trends, the charts, everything you know about trading Apple. But first, why should you watch this channel? I bring your questions about this enormous company. The holidays are coming, and I bring your questions to a couple guys who manage and maintain over $100 million in real estate, businesses, multiple businesses, and stocks. We will talk about Apple today, and you will learn everything there is to know about Apple moving forward, both financially and as a stock. Let's get after it, Paul.
Thanks, Seth. So guys, really quick, follow us on our new Instagram account, Everything Money Investing, and then follow us personally so you can see cute pictures of my puppies. So let's go to our exclusive Everything Money software. We're going to go to the 8 Pillars tool, type in Apple. All right, guys, so Apple. Apple is an interesting company.
Well, they got the new phones coming out, Paul. I know Mo's going to go over the charts. I mean, Christmas is coming. I know you're buying me a couple iPads, which is nice.
I read, and I read that they're expected to sell 40 million iPhones this Christmas, even though there's a chip shortage.
Yeah, it's interesting. They said that, so they usually do sales, and like third parties will do sales like AT&T and stuff, and there's no sales on iPhones this year expected, just because the demand is so big and they can't supply it. So there's really no sales on. They usually will drop the price on them for Christmas. So they're going to drop the price on like headphones and iPad minis and such, but it's not going to be on like iPad Pros, iPhones, etc.
Okay. All right, guys. So let's use our 8-pillar analysis. So first off, guys, Apple's one of the biggest companies out there, almost a $2.5 trillion market cap. That is large. Now, our first pillar is we want a 5-year PE under 22.5. It's 39.23. That's an X.
Yeah, smidge high.
And last year's PE was 26. So a little rich. Pillar number 2, we want the 5-year return on invested capital to be greater than 9%. Is 30% good, Seth?
Jeez, really?
Yeah. So years ago, somebody I knew who was a trader reached out to me and said, Paul, what do you think of Apple? And this was when Apple was selling for like 9 or 10, 11 times earnings. I said, listen, it's an amazing value play if you believe that their revenue is sustainable. At the time, I thought to myself, who's going to buy more iPhones? Who was right? Not me. I mean, I was so wrong on that one because that's always the concern when you have a big company that dominates the market so much in a very fickle industry. Like, it's not hard for people to change their phones, right? How hard is that?
Oh, all the commercials are just switch over. We'll give you a free one.
Well, I'm not talking about the actual service. I'm talking, you mean, yes,
both,
like Samsung. Yeah, you're right.
Yeah.
Okay, so far we have 1 X and 1 check. Pillar number 3, revenue growth over the last 5 years.
I'm certain this is...
Oh my gosh, Seth, look at this. We go to the income statement, $230 billion to $365 billion. And look at this big jump last year. Now, why would we have this big jump over the last year, guys?
We were all staying home and trying to educate our children.
Yeah, everybody's buying new devices and such.
Yeah, so the question we have to ask ourselves is this growth sustainable? Listen, there's so many stories about, just like I talked about with CCL. CCL's revenue dropped like 99.5%. Is that a permanent drop? No, they were shut down. The same thing happens with companies like this. Is this a permanent increase in their revenue? Like, is this going to go up from here? Or are they going to see a drop? I don't know. But this is something to consider when you're going forward and looking at companies, okay? Pillar number 4. What is pillar number 4, Seth?
This is profit growth over the past 5 years.
You finally got the term
correct.
Yeah,
actually, I like how you asked me. When we got to 4, that's when you asked me. I like that. Thank you so much.
So we scroll down a little bit on the income statement on our software. $48.35 billion to $95 billion. Yeah! That's almost doubling, pretty much doubling their profit in the last 5 years.
Chickity check.
But look at last year. So first off, I want to say 48.4, 59.5, drop, increase, and then skyrocket. Again, is that profit sustainable? I don't know. And it's already selling for, we saw before on the main page, it's selling for 26 times last year's profit, but this profit is ginormous. It's 60, 70, 80, whatever the number is, 80% higher than the previous year. You have to factor that into your future assumptions, okay? Pillar number 5. Now, this is one of the most overlooked but most important pillars. It's share dilution. It is shares outstanding. So here's why it matters. If a company has 100 shares outstanding and you own 10 of them, you own 10% of the business. If they all of a sudden issue 20 more shares, taking their shares from 100 to 120, you still own those 10 shares, but now it's out of 120 shares, which dilutes you from 10% ownership to 8.33% ownership. Okay? This is so important because companies can do this. Like I say the crack dealer on the street. If people love the stock, companies will keep issuing shares out there, let people buy it up, and dilute the other owners. So what we do is we scroll all the way down in the income statement. We look 5 years ago, 20.6 billion shares outstanding. They now have 16.49. That's a check. We want to see that number going down. Now, I will say, the company's kind of expensive, so I don't want Apple spending too much of their free cash buying back shares of an expensive stock, because that's essentially like them overpaying for another company. Buying back your own shares is still investing your own capital. But either way, it's still a check. So far we have, the only X we have right now is PE, 5-year PE, right, Seth?
Yeah, 5-year PE, you're right. Pillar number 6 involves their debt. Go ahead, Paul.
So I'll speak this on blue in the face. A company with less debt is more likely to stick around, right? Because just like your neighbor, Seth, doesn't your neighbor have the exact same house as you, basically the same car, same life? But if they have $10 million in debt and you have 0, who's more likely to go under?
Yep, you're right. Of course.
It's no different for companies. So we want companies that can stick around. That's how you're going to compound your money more and more.
Normal people, I talk to folks, they don't think about this that often. They don't even take this account. Obviously, when buying a stock, forget about shares outstanding, but looking at debt, this is intriguing.
Warren Buffett always says that whenever I see a smart person go broke, it's because of one reason only. And what's that, Mo? Debt. Every single time it's debt. That's all it is. So what we do is we go back to our main page. We look at our 5-year average free cash flow, $68.2 billion. We multiply that by 5. That is $340 billion. So we want their total long-term liability to be under $340 billion. So we scroll up to the top. We go to our trusty balance sheet in our exclusive software. We scroll to the very bottom. Total long-term liability is 162. Yeah, they can pay this off in 2.5 years, essentially. We're good. They have plenty of cash to pay off the long-term liabilities. Now, the last 2 pillars are the ones that I love the most. They involve free cash flow. Why do I like free cash flow over net income? Either one of you. Seth first, because he's the average guy.
Well, I really am learning the difference between income and free cash. You say that income can be sort of manipulated, but free cash is cash in, cash out, cash from operations minus capital expenditures, and they can buy back shares. They can reinvest in themselves. They can make acquisitions, which you sometimes do or don't like.
Yep.
They can, I forgot the last 2, Paul.
So it's pay dividends, buy back shares, pay down debt, make acquisitions, and invest back in yourself, right? So what Seth was saying before is net income has rules based on SEC and accounting rules, IRS. They have all these rules that can kind of be massaged at times. Now, cash flow can be massaged as well, but it's much harder to do so. So as Seth said, we go to our cash flow statement. The first thing we want to look at is free cash flow growth. So we scroll down. We look at cash from operations less your capital expenditures. Now, because your Uncle Paul loves you so dearly, like Santa Claus does,
yep,
I've added this line to our software. So it makes all the math easy for you. It does all this for you. So 51.77 to 93 billion. That's a check mark. Yeah. Massive growth. Our final metric, we want to apply a multiple to our free cash flow to come up with a starting market cap to kind of see where we stand. So I look at our 5-year average free cash flow of 68 billion and I multiply by 20. And that is $1.36 trillion. Is that the right? Whatever it is, it's around there. So we want our market cap to be under this number. It was 2.5.
Yes, trillion.
That's an X. Now, does that mean we're not buying Apple? No. Guys, we pick a standard 20 multiple. But as you know, if a company's going to grow 15% a year versus a company that grows 3% a year, we should be willing to pay a premium to the company growing 15% a year, right? And Apple is not making any sizable acquisitions that's adding big numbers. So it's pretty much all internal organic growth. Like the concern we had about AT&T in the past was they're making big acquisitions that's how they get their growth. I don't like looking at growth numbers based on big acquisitions. I like going based on natural growth, okay? So, folks, look at our 8 pillars tab right here. This does all the math for you. We've incorporated this because instead of doing all that work, you can just click on the 8 pillars tab. And what do we have here, Seth?
Just valuation.
That's it. This is a very common thing among companies we like. valuation's a problem. So what am I sitting there thinking to myself? I'm going to use a stock analyzer tool next to determine if the growth of Apple is something that can be justifying the price paying today, okay? This is a very popular tool we have, so let's go to the stock analyzer tool. Now, for a company like Apple, the first thing I have to pick is how many years of analysis am I looking at? Guys, do we think Apple's going to be around in 10 years?
More likely than not.
I think because of Mo and Seth alone, we're probably buying enough stuff.
Well, I broke my kids stood on another iPad.
What do you mean they stood on it? How do you just stand on an iPad?
I'll tell you how, Paul, and you'll learn this when you have a couple Bambinos of
I'm
your
not
own.
going to have a couple Bambinos.
So they use it right before bed, and then they just put it on the ground next to them, Paul. Then when they wake up in the morning, it's ta-da, Daddy's buying. I berate them and scold them and beat them mercilessly, and then we get a new iPad when we need one. So
And then you reward them.
Okay,
Allegedly.
so I'm going to look at a 10-year analysis
don't
for
beat
Apple.
them,
You can
of
do
course,
1 to 20 years. Number of assumptions. You can do 1, 2, or 3 assumptions. We tend to do 3. Now, guys, this is where we have to really break down. Every investment is the present value of all future cash flows, right? So what we're going to do here is we're going to make our assumptions on the stock, and it's going to spit out a price we need to pay based on these assumptions. We make this very easy for you. Now, your assumptions, your spit out number is only as good as the assumptions you're making, right? So we give you your 1, 5, and 10-year numbers here, and you can make determinations. So guys, do you all see this?
Yeah,
10 years, they had revenue growth of 10% a year. Last year was 33%. Last 5 years was 12.4. So give me a low, middle, and high number for each of these for the revenue growth numbers for the next 10 years.
I hate to get these wrong because someone may
There's no such thing as right or wrong, right? Because we don't know what the future is going to be.
I see.
But it's about being reasonable. It's about being conservative. Our goal is to make conservative assumptions and then buy based on, oh my God, based on these conservative assumptions, the stock is still a good buy.
Yeah, you typically say when a company gets this large, they can't keep up this massive growth, like our Tesla fanboys are
Which I was wrong on with Apple 5 years ago. So just keep that in mind. But I still think at $365 billion in revenue, how do they sustain that?
Tell me yours and I'll tell you mine. For revenue growth.
Let's go with Seth first.
Okay.
Let's see what Uncle Seth
So
comes
low
up
is like, I mean, what are they going to do on the worst end? 8%?
Okay.
Would that be super
What about
low?
middle?
8, 10. Oh boy, I don't know. This confuses me, Mo.
Okay,
See,
Mo, what do you think?
I'm going 8, 9, 10.
Awesome. I was going 4, 6, 8.
Well, this is why I wanted
Because
to
we
go
had a big
first.
jump last year.
Correct.
And guys, how are they going to, I mean,
Correct, but I've said it a million times. I'm going to keep saying it again. I don't even think that they've scraped the surface on subscriptions yet. I really don't.
yes, but remember another thing. Their Apple, remember they got sued for their App Store.
They
They're
did.
losing that revenue. That's like 50% of their revenue on the subscription business.
But I think, that's just App Store stuff. They still have fitness to get into, home fitness. Peloton just came out with that device that they put on top of your
okay.
TV.
So
But
can we agree to 5, 7, 9? Here's why, Mo.
Okay.
Look at
I'll give it to you.
10%.
But I put in.
If we do 10% for 10 years, that takes the revenue to $1 trillion in 10 years.
It's currently 365 revenue.
Is that outside?
$1 trillion?
But if there's going to be a company that's going to get to $1 trillion in revenue,
I don't think it would be I think it would be Amazon.
well, but I think that Amazon and Apple can ride together.
Guys, I personally can't swallow anything. I'm going to do 5, 7, 9. I'm vetoing. Now, profit margin.
Tim's laughing.
Profit margin. Their profit margin has gone up, but it's look at 5 years and 10 years, exactly on the nose, the same
consistent.
profit margin.
Wow.
So, give me a profit margin for this. Is the profit margin going to stay high? Is it going to go lower? Now, if Mo's right,
I think it's going to stay high because they're going into subscriptions.
yes,
And
So subscription
Margin would go up.
margin will go a lot higher with subscription. So give me some margin numbers.
So last 10 years, he did 22. So how about 20, 25, 30?
I was going to say 21, 23, 25.
I agree with that one more. 30% is
Way
big.
too
I
much.
mean,
Okay.
to me, that's a huge number. But so would you say, Mo?
21, 23, 25.
Because with margin, even a 2% increase in margin's huge.
Oh, I don't know that.
yeah.
Okay.
2% margin increase is ginormous.
Okay.
Okay, free
Wow.
cash flow margin. So it's been pretty similar.
Yeah, it's really similar.
Very similar.
I'd
So
almost
what
put
are we
it the same
thinking
as
here?
Profit margin.
I'm thinking 25, 23, 25, 27.
27. Okay.
Okay, PE. Now, guys, this is the big one. What PE are we signing to Apple, in the future?
I'm saying 16, 18, 20.
Now, remember, the higher the PE, the more growth rate they should have, but also you should pay a higher PE if they're so ingrained in everybody's life
They
that
are.
it's hard to switch.
At this point in time, they have over 2 billion devices in the hands of people. We haven't even gotten into other continents.
I remember, okay, so Seth, what do you think?
Jeez, every time Mo gives me these stats, I'm just like blown away. I mean,
Well, don't have recency bias in here, but it's the last thing you hear. Because remember, my goal is to make conservative assumptions and still buy it if the conservative assumptions are still higher, net a higher price than what it's currently selling for. I don't think 16, 18, 20 is a conservative assumption.
that's too high.
12,
I think
14,
that's too
16?
high. I think 12, 14, 16, that's my opinion.
Yeah, that's what I thought you would say.
Let's do this. Let's do 13, 15, 17. Because I do agree with you that if the more and more Apple gets ingrained in people's lives, it's basically looking more like a T-bill. Like it's very secure.
Yeah.
Especially with low amounts of debt. So I do agree with that. And we all agree that we should assign the same ratio for free cash flow because look at how close their PE and free cash flow numbers are. Right? Now, guys, what desired return we want? We always say 12.5%. And what's the reason for that, Seth?
Well, if you're at home, you can just put your money in a standard ETF and get a little under 10%. So if you're going to increase your risk and put your money in one company that could inevitably fail one day, you want a high risk, high return, or not high risk, but you want a better return. So we're going to strive for a 12.5% return over 10.
We hit the analyze button very simply here. Boom.
What is it?
All red.
Well, what's the price range?
The middle one's basically $90.
Okay. And the high end is 120?
120.
Okay.
So guys, you might be sitting there thinking to yourself, oh, come on, it's not going to get there. But guys, remember, every investment is the present value of our future cash flow. And I can guarantee you that our big difference in price was driven by these multiples right here. Because right now they're selling for 26 times earnings and free cash flow, and we lowered them to 13, 15, 17. So you might be sitting there saying, you guys are being conservative. Okay, if you agree with Mo, and you should assign a 20 all the way across the board, it's still expensive. That's
There's no
my
doubt
point.
it's still expensive, yes.
It's still expensive, assuming 20 times multiple for Apple along the way. Let's go even crazier. Let's say it sells for the same margin, same multiple it's going for today.
Oh, Paul, this was a $50 stock by Christmas 2019 or mid 2019.
Of course.
It rebounded from COVID in just a couple months. It was $80 after COVID.
If the multiple stays the same, Seth, than what it is today, there's only one number, the highest of assumptions, that makes it worth it today. This is just to show you guys that when we factor in, we have something like the stock analyzer tool that can tell you how these changes affect things. It brings everything into reality as opposed to, oh, it's going to grow, it's amazing, and then we just pay whatever. That's what happens out there.
And even though my assumptions were more liberal than Paul's, to me, I'm still looking at purchasing around 120 and lower. I'm not saying go and buy the stock today by any means, because I do still think it's an expensive stock right now.
So, Paul, tell our viewers about how they can get this behind you.
So we created the software because our original subscribers wanted to be able to do their own research and analysis without waiting for us to make more videos. So we created the software just for them. What's included is everything you saw here, including our amazing stock analyzer tool. You get 30 years of financial data, access to Seth, Mo, and I. You get exclusive daily content, 2 or 3 videos per day sent to you only through our software and our mobile app. This software back here is on the App Store and Android, so you can use it on the go. Everything there is included. All the extras, retirement calculator, real estate calculator, everything here is all going to be included in your subscription. But most importantly, if you feel alone out there, which a lot of our subscribers do, they joined our community with over 6,000 people, and now they can talk to everyone around the world 24 hours a day about their own investment ideas to bounce things off each other, talk about things. You're no longer alone in your own island. You can have these conversations with everybody. This is all available for only 90 cents per day. This is a no-brainer, 90 cents per day. If you're just able to either increase your returns by 1% or decrease your losses by 1%, this could lead to hundreds of thousands, if not millions of dollars a year. And you can also fire your financial planner, saving hundreds of thousands of dollars in your lifetime. So sign up, everythingmoney.com or Patreon. Either one gets you access within minutes. The benefit of everythingmoney.com is we do not charge sales tax yet because of our size. So sign up, 90 cents a day, less than a cup of coffee, no brainer. Make the best decision if you are serious about your financial future.
Looking to trade Apple at a quicker pace? You can join the Bidnass Nation, join our community, and Mo will walk you through the charts about Apple. And look at that sweet spot, Mo. What you got over there?
So I'm going to show you all 3 charts, which is the long-term chart, the daily chart, and the day trading chart, because Apple is a great stock for day trading. So what I'm noticing here is these are your previous highs, and this is an all-time high with Apple. So this is kind of a head and shoulders pattern. It's had a lot of difficulty breaking through that all-time high. You've seen that it's failed twice. So right now I'm thinking with that head and shoulders, head, shoulder, shoulder, it's going to get to this point and it's going to probably fall back down somewhere in this range. Now, let's look at it from a daily perspective. This is where you can capitalize on some gains. So look where we are in the sweet spot right here. All you need is one engulfing candlestick that's green coming up like this. Run it to that previous high of just above $152, and that is where you will be able to make some money on Apple. Now, the other good thing, Apple has a lot of volume, and it has a lot of volatility in its range, and that's where you can come over to a 15-minute chart and learn how to day trade. Come over 80% and wait for these engulfing candlesticks in good volume. Here yesterday you had a little bit of a run. You could have caught this little downward run on you. So what do we have today? Today, actually, it's looking like you could sometime short this maybe today. But the point is, I just pointed out 3 days in a row where you can day trade Apple.
This sounds scarier, Mo, day trading.
Yes, it does. But
you're saying if I sit, follow these charts, follow these rules.
Correct. You can sit here. If you have time to sit at your computer
all day,
multiple hours a day.
Okay.
Well, if you have a job where you can do that, or if you don't have a job and you want to maybe turn this into a career, this is the place to come. If you're interested in learning to day trade, come and join me in the Bid and Ask Nation. You will get access to all of my trading seminars, the Trading 101 series, the Employed Trader series, and you will get constant access to me and 900 other people that are all interested in trading, and they will help you. Come and join the Bid and Ask Nation.
Paul, I was rereading this book last night, Richer, Wiser, Happier. We're interviewing the author, William Green. We're interviewing the first chapter about Manesh Pabrai, and he reiterates the idea, Paul, about Warren Buffett's take is like one of the top keys to investing is just extreme patience. And I think Apple's one of those companies. You know, just a couple years ago, it was just a normal stock trading at a normal variable, and we just need to wait, like a lot. You know, learn as you say.
Now the wait is for it to come back a little bit further south. That's it.
And that might happen. I mean, with the shortage now,
especially the Nasdaq takes a plummet either way.
That's our take on Apple. Fondle thumbs up. Thanks for watching this video. We appreciate your support. Join the community, and we'll see you there.